Yeah, hello back. Now we have to talk about the hierarchy of legislative texts again, or for the first time. And well, you have seen in the area of value-added text, there is a mass of different legal rules or legal texts. And now, when you have such an enormous amount of legal text, it cannot be avoided that former or later there will be conflicts between what these two or three different tax acts or legal sources say. And so you have to find out what's now the right solution of such a conflict. And it's a standard situation in law that you have different orders by the law which contradict each other. So there are standardized rules for dealing with such contradictory orders given by different legal texts. The first general rule is the younger law prevails always over the older one as far as a conflict goes. So if you have something which the legislator said later than what he said before, then a clear thing is what the legislator said last. That's his current will and its current intention, so that counts most. The next principle would be the special order or the more special law prevails over the general rule. So if a rule for all cases says something, and there is also a rule especially for cases like the one which you have here, then that specific rule makes only sense if the legislator wanted to deviate from the general rule. So that is evidently what the legislator wanted. If an exception is made, naturally, one wants you to follow the exception. And so the more special rule prevails over the general rule. So that's clear. Now, these two rules also allow a conclusion to the contrary, which is a bit of a complicated way to formulate something which is rather evident, because in case of an older and a younger law, as far as the younger law does not give a counter order to the older law. So as far as the younger law remains silent on what the older law says, or it doesn't order the contrary, then as insofar the older law remains valid. The same with the general rule. Wherever the special rule does not apply explicitly, the general rule comes back to life and will be applied again. That's highly dangerous, because if you do something which is a bit outside of the scope of the special rule, then it's no longer covered by the special rule, and that general rule comes back to life and is applied to that case in front of you. And the third rule is something which you should already know. Within the European Union law prevails over any other law, so over any national law. You probably, if you don't come from the area of the European Union, you will find probably similar rules in other constitutions, wherever you have different levels of state legislation. Most states have that rule that the federation legislation prevails over the local legislation in cases of conflict. We already know a similar rule inside Germany too. Legislation of the federation prevails over federation state legislation, and federation state legislation prevails over statutes made by a city or similar thing. So it's clear Also, that is common sense. What the highest authority says has a higher importance than what the lower authority says. What is sometimes not so clear to everyone's mind is the case or the fact that if you have a very general statement in EU law, which gives you a clear order for cases, and this statement applies to your case, then although it has a very general nature, it has to be followed against the order, which might be very specific, focused on taxation, of the lower authority, so of the national law. Because whatever the higher authority says has a higher rank and has to be followed more in cases of conflict than what the lower level said. How can we illustrate that? Well, special rule against general rule. Imagine you sell chocolate. Then grocery shop owner sells a bar of chocolate. Price is 0.50, so 50 cents. How much VAT must be paid? In the VAT law, we have two rules. The first rule says everything costs 19%, but then a second rule says chocolate is 7%. Now, both together is not possible. It's a direct conflict. Either it's 19 or 7. And here is clear. 7% is the specific rule for chocolate. 90% is for everything. The specific rule prevails over the general rule. So chocolate is 7% tax rate. Think about something else. The traps or the risks from the conclusion, to the contrary from that principle. Imagine, again, under German VAT law, everything costs 19%, but milk is taxed with 7%, special rule. Coffee in form of coffee powder or beans is 7%, and water, so in the poorest version from the crane in the wall, is also taxed with 7%. Now, if you put all these three things together into a plastic cup, shake that, and sells it under the name of, let's call it Mappuccino, for €2 in the supermarket, what will be the tax rate for that? So we have here a small cup of plastic. That's only an ancillary service, so that does not count. Probably only the contents, the drink which you mix, counts. That drink is milk, 7%, coffee, 7%, water, 7%. Shake it and you have Mappuccino. Now, what does the outcome cost? What is the tax rate? Now, Mappuccino is first covered by the basic rule. Everything costs 19%. Mappuccino is a part of everything. This general rule applies everywhere where no special rule applies. So let's check the special rules. There is a special rule of 7% for milk, but the product is not milk. Milk is one of its components, but it is no longer milk if coffee and water are mixed in. 7% is also for coffee in form of powder that you have done coffee powder. You have added that to the milk, but the product is no longer coffee powder. So definitively not. So that rule does not apply. Water from the crane, probably you took some water to make the coffee powder more fluid, but this is no longer water, so 7% rate for this is also out. So we end up with none of these three rules apply. So although the general rule remains applicable, 19%, the only chance you have to get out of 19% is to find another additional special rule which might be applied specifically for Mappuccino. Otherwise, you pay 19%. It does absolutely not matter that all three ingredients are 7%. The decisive thing is the law is applied in a way that you check every individual special rule, and you will draw a blank every time it goes wrong for all the three things, because when you mix them together, something new began to exist, and that something new was covered by none of these three rules. By the way, under German law, there is an additional rule which indeed says mixed drinks which have a percentage of ingredients of milk of more than 75% is also entitled to a 7% rate. That will probably give you an incentive to put much milk in it and hold the coffee and the water percentage in the ingredients relatively low. But if, for example, you only fill in 74% of milk, then it would automatically be covered by 19%, because then even that specific rule would no longer apply. Naturally, you might also perhaps like an example for the consequences of a conflict between European Union law and national law. And here we have one from the field of VAT again. Imagine that the VAT directive says that a certain transaction shall be tax-free under VAT law in all member states. Now imagine further that Germany has forgotten to transform that order into its law, and so it still subjects this transaction to VAT according to its Umsatzsteuergesetz, the USDG. Now, what will be the correct legal treatment? We have now a conflict between what EU law says and what national law says. First, the national law here says that the taxpayer must pay. The directive says the taxpayer need not pay. So, direct conflict, clear contradiction. Now one could bring forward that the directive itself is not a law. So it neither creates rights or obligations for the taxpayer immediately. So one could have the idea, we have here only one real law. That's the national law, and that national law still unfortunately claims a tax, and so taxpayer has to pay. But on the other hand, that would lead to the consequence that a state which violates its European Union law obligations and does not create the demanded tax exemption could still collect money and profit from the violation of EU directives orders financially by getting more taxes. And whereas states who follow their obligations would have to bear a loss of tax revenue from the moment onwards when they correctly created the tax exemption. So somebody violating obligations would profit more than somebody correctly following orders. And this is a result which would be fundamentally violating the fundamental principles of what is right and fair. For this reason, the European Union Court has always held that an unwritten principle of right and justice, that a state which violates the orders of a directive cannot profit from this violation, and that therefore in such a situation the state has no valid claim for levying such a tax anymore. They can even show this with referring to the text of the EU treaties, because the treaties say the directive is not a law, but it's binding for the state. And they say, well, if the directive says no tax can be collected, this directive is binding for the state, and that means all parts of the state. So even a fiscal authority is bound by the directive says the state is not allowed to tax something, to levy a tax or collect a tax for a tax-free transaction. And although the directive is not a law, it's nevertheless binding for the state. And so the state is by the directive forbidden to collect that tax, forbidden to assess it, forbidden to decide in a court to the disadvantage of the taxpayer, because all state institutions are bound by the directive's orders already. So here sometimes people talk of an indirect, immediate effect of a directive in the favor of the taxpayer, because if the taxpayer says, I detected under the directive I am tax-free, these state authorities are no longer allowed to collect that tax. By the way, the state authorities have even to comply with the orders of the directives on their own. They need not to wait until the taxpayer claims or brings forward that claim. Another similar situation, which has a slightly different outcome, but the same underlying logic. Now imagine it is the other way around. German tax law says there is a tax exemption for universities which do paid research for others. By the way, that exemption really existed some 20 years ago or so. It had the peculiar aspect that such an exemption was not allowed under the rules of the VAT directives. Such a transaction had to be taxed regularly. So here, the German law contained a tax exemption which was not allowed by the directive. Now, again, how has this conflict to be solved? Imagine you are the person which has to do the tax declaration for the university in question. Are you now obliged to declare your turnover from research activities for which others paid you, or can you leave it out with the argument, I'm tax-free under German law? The answer now is, again, national law says you don't need to pay. The directive says you have to pay. Here you have a conflict, but special aspect, a directive is according to the rules in the EU treaties, not a law in itself. A directive does not create obligations for taxpayers and other citizens. The only institution for which it can create an obligation is the state. You and I, the citizens, are only subjected to laws. And in contrast to an EU regulation, a directive is explicitly not a law. So the directive can be no legal basis to raise a claim against a taxpayer. The only way which you have to raise a tax claim against a taxpayer is the law. And here we only have one legal rule, the German VAT law. And so that means as long as the German law says you don't need to pay, you don't need to pay. So we have a different outcome than before, but the same underlying logic. This the peculiar character of a EU directive. And we have even an interesting effect in cases where a state does not follow the orders of a directive. It's always the state who suffers the financial loss. In cases where the state wrote, I want to tax you, but it's forbidden, the state bears a financial loss. State cannot collect the tax. The other way around, in cases where the directive says you should levy a tax, and the state has a tax exemption, the exemption counts and the state loses the money. So, basic effect or common aspect in both cases, wherever the state deviates from a directive's orders, the state bears a financial loss. This is, by the way, a relatively strong incentive not to violate a directive's orders. Yeah. You might now even have a conflict between two valid laws on the EU level and the nation level. For example, imagine there is a rule for distance selling. This is at the moment just changing in July 2021, but the old version just said the place of delivery of goods which you sell over a distance and then send by mail or in a similar way to a private customer. The place of delivery for these things changes, and you have to tax them in the country where the customer lives if the turnover from such deliveries to private persons in that particular state made by that same supplier surpasses a certain threshold in a given year, for example, 100,000 euro for Germany. And now there was some 25 years ago a kind of a conflict, and so it could be different interpretations concerning what happens when the threshold is passed. Imagine a national legislation says if the threshold is surpassed, all sales within the same year become taxable, even retroactively from the beginning of the year. But the EU VAT implementation regulation states clearly that the threshold is to be interpreted in that way that only from the moment onwards when the threshold is surpassed, this sale and all future sales have to be taxed in the country of destination. So you have a clear conflict between the two orders. And here EU law is a law, national law is a law. Both can create obligations and rights for the taxpayer. And in that case, the EU regulation clearly prevails because it's the rule issued by the higher authority. So this gives you an idea of the legal framework where we have to deal with in the field of VAT. One might also imagine that there might be conflicts possible between national law and some rules of primary EU law, like the fundamental freedoms or other things, but that's rather remote. But always have that rule that if there is a conflict between two rules on different levels, the higher level prevails. And what you should especially memorize is the, let's say, twofold effect of deviating from a directive. If the directive is more in favor of the taxpayer has a right to be treated in the favorable way, because then the state is forbidden to go beyond what the directive asks. And on the other hand, if national law is more generous, then the taxpayer can invoke the specific nature of a directive and can say, well, as long as national law does not contain a claim against me, I am not bound by a directive. I am not the state. I am a citizen. Yeah, that's again a small chapter. And so that's enough for this video. And more is soon to come. Thanks for watching. Hope you enjoyed it a bit. If you didn't enjoy it, enjoy that it's over. And in all cases and under all circumstances, I would be happy to see you again for the next video of this series. Thanks and goodbye.